Sure.
I think the best way to start is to ask Andreas to introduce our guest today. Many of you know our guest, but it's always nice to start with an introduction.
Today we are talking to Stephan Morais about, of course, exiting and how founders and VCs work together on developing and executing on an exit strategy. And we are super excited to bring on Stephan Morais because Stephan has been a pillar in the both, as I said earlier when we were waiting, in both the European and Portuguese ecosystem. Stephan was one of the very first VCs, real VCs in Portugal, if I dare say so, investing in deep tech and really taking on the risk of helping startups get off the ground. So we're super excited to bring Stephan here to you. Stephan has great success stories like Farfetch and Babel and Tier in his portfolio. And I'm sure that Stephan will also be happy to talk a bit more about their investment strategy and who they are as a firm. So from now on, I actually just want to kick it to Stephan to just say a few words about yourself, Stephan, and also Indico Capital.
Sure. Thank you so much, Andreas and David, for inviting me. Great to be with all of you here and share a little bit of our experience. So I'm originally an engineer that then did an MBA at Harvard Business School. That's where I found out that I would like to become a VC one day when I'd grow up. It took me then another 15 years to actually grow up and become a VC or so. And but I did lots of things, investment banking, consulting. I was a CEO and an entrepreneur for a while. And then about 8-9 years ago, I joined the board of Caixa Capital, which is the private equity and VC arm of the largest bank in the country. And at the time, the Portuguese ecosystem was kind of starting. It was kind of, the first interesting companies were starting to fundraise and calling some, the shots internationally. Portuguese companies that would go to Silicon Valley, to 500 startups and YC, Techstars. And we were very fortunate to have backed all of them or almost all of those success stories. And then in 2017, after developing, a very nice track record, I decided to go on my own and form Indico. It took us then 1.5 to 2 years to fundraise. So, the life of an entrepreneur is fundraising, and it's tough. And you see your bank account just going down every month like this, woo, until finally you kind of land and you start, going up again with the management fees. So, being an entrepreneur, as we all know, is not easy. It's not for the faint of heart, but it's fun. And if you love what you do, it's definitely the career choice, because you spend most of your time working. So you might as well do something that you like, if you can. And so after 2018-19, we raised the first fund. That's a 54 million euro fund, investing primarily in sort of pre-seed to Series A opportunities. We are basically the fund that takes mostly Portuguese companies global. Hopefully pick the right entrepreneurs, the right projects that can actually, own a vertical or an industry in the future, and then work very closely to those entrepreneurs in strategy, everything that has to do with sales and marketing, hiring and sort of talent acquisition, and then of course fundraising, and last but not least, exiting. And so after that fund, which is a 54 million fund, we were approached by Google about a year or so later to do the Google for Startups program in Portugal, which we are their sort of partners for Portugal. And we raised another 12 million fund on the back of that. And now more recently, we're putting together another couple of funds to do top-up investments on the portfolio, and then to also get into new sustainability verticals. So we're about to have big news, and those in our portfolio. Basically, we looked at 2,150 or 170 deals in the last 3 years, to give you a sense. We invested in 27 companies, so extremely hard to sort of convince us. It doesn't mean that we get it right all the time, but we do get a lot of deal flow because of the track record and because we have backed, all the unicorns. And our partner Christina is a unicorn herself, in the sense that she founded Talkdesk, a company now worth 10 billion, which is mind blowing for a 34-year-old. So she's a super inspiration for all of us. and basically, those 27 companies, we have invested 32 million, but they have now subsequently raised more than 870 million. So in 2.5 years, 3 years, we have multiplied our value by 20 something times in terms of the capital raised, and the funds are doing very well. Top quartile IRRs about 30% year on year. So we have global investors from all over the world, individuals and institutions, and of course, things have been going very well. We've been very fortunate. It is also true that the industry is doing very well. It's never been as good in the history of our planet to be an entrepreneur, and of course, it's also good to be a VC if you end up investing in the right entrepreneurs, which is what we try to do. At the end of the day, we are in the business of investing, so becoming shareholders and active shareholders with our entrepreneurs. And then we're in the business of selling. So we're actually not in the business of investing. We're in the business of exiting, because until we exit, there is nothing. It's like when people say, oh, should I take this job or that job? And I always ask, show me the contracts. Oh, but I don't have the offer. So there's nothing to decide. If you have no offers, there's nothing to decide. Exits is the same. We all have great paper value. We've done already a few exits, of course, even on these funds. But until you exit, you're really you're just paper worth, millionaire or billionaire. So the exit is the crucial step at the end of the day, so that the entrepreneurs get their returns and the investors get their fair share as well. So very happy to be here. Small introduction, and happy to.
And I actually think that you Stephan, you brought us right into the topic there, and I think that we should maybe double click on the point that you said with paper money, because there is nothing more, at least for us looking very closely at the industry, that there's nothing more highlighted right now than the fact that there seems to be quite a lot of paper money around that will be difficult to translate into actual currency. What are your thoughts on this?
Are you talking about crypto or about VC?
I could have been talking about crypto, but here I'm just talking about good normal equity that seems to be maybe a worth.
Old school stuff. No tokens.
So Stephan, I'm very curious to hear your perspectives on this, because yes, we are in the business of investing, but we're very much also in the business of exiting, and everyone is holding their breath right now, I think, as to see, can we actually exit at the multiples that we're right now championing our companies at? And I'm curious to hear what your views are.
Right. So I think that the first thing is that quite often everybody forgets that the idea is to exit as soon as possible for the highest valuation possible. As soon as possible sometimes is a couple of years, sometimes it's 15 years. You never know, right? A lot of the times our investors, when they are, or the potential investors, when they're doing due diligence on our fund, they ask us, so what about exits? Tell me about exits. And I always say that as an early stage investors, when things go well, we do not do the exits. When things go, really bad, we do not do exits, because the company ceases to exist. So there's no point on doing any exit. And when things kind of go average, we do exits. And I'll proceed to explain. Because we're early stage investors, at some stage, the companies that are doing well, they will raise Series B, C, D, E, and F sometimes. And we're not going to be part of those rounds. We might put in a little bit of money or a little bit of capital, but we're really no longer leading. We normally lead, we're at the board and so on until Series A, B, C, maximum normally B, not much more than that. So when things go really well, it's those later stage investors that have done, decades and decades of exits, and that will lead the entrepreneur towards the exit. And this could be a trade sale or an IPO. When things go very bad and the company doesn't make it, there is no exit, right? We all lose our money, and we're not the type of VC that calls a €1 exit as an exit. We just say, rest in peace. Hopefully everything went, everybody behaved well, and that's your exit. There is no exit. And so what happens is that sometimes companies go kind of sideways, and you reach a stage where you think, okay, this is probably not going to be a unicorn. It's a good business. There's an interesting technology, or an interesting client base, but for some reason you cannot grow it exponentially. And that's when, you know, VCs like us, which are early stage VCs, need to provide the exit. So the exit on the successful, super successful path, we're talking about hundreds of millions or multiple $billion exits. These are done mostly by later stage funds, quite often with lots of advisors involved, be it an IPO where you obviously are going to have the typical investment banks, or a trade sale where you're going to have probably an auction, private equity style. You know, your advisors and the VCs together with entrepreneurs will put together an auction, and whoever has the best fit in terms of either for the valuation or the strategic fit or the alignment with the founders, or a mix of all these things, will become sort of like the new owner of the company. Say Google buys the company, or someone else less known. When there's an average situation, it gets a little bit more complicated, because you're not big enough to sort of do an IPO. Mostly, you know, you have to have a certain size and a certain profile to be taken by the public markets. And you're also not a super high growth company, so you're going to have naturally less suitors in terms of corporates that would like to buy you. So you might have to explore different options in terms of mergers, in terms of equity swaps with other companies, or just, you know, going after your potential buyers instead of them coming after you. And that could be done in conjunction with advisors once again, or just the board and the team will conduct the process, particularly if you have VCs on board that have done investment banking, that have done exits, and that have, you know, the technique to do M&A, because M&A is a profession, right? It's not something that you will wake up one day and say, oh, I'm going to sell my company. No, there's a way to do it. There's a process, and if you don't do it well, if you don't do it in a timely fashion, you might lose the ability to exit. So in essence, that's the sort of like the general comment.
We got a question from the audience, and I do want to take them as soon as possible, but maybe just to get us into the topic first, Stephan. We have a very split community as to whether a founder in the pre-seed seed stages should be thinking about exits and talking about exits when pitching to VCs. I'd love to hear your perspective on that, and juxtapose the two views and say why you think as you do.
Yes, for that specific question of, you know, when we receive a pitch deck and we see on a pre-seed level, you know, a company that has barely a product and maybe some pilots and some clients, but nothing much yet, it's kind of interesting to see that people have thought about the exit, and they say, well, you know, one day I'll exit this type of corporate. You know, if you're saying one day I'm going to exit as an IPO, that's kind of useless, right? I mean, we all know that that's an option. But if people have thought about potential exits, it's fine, but it's just not expected, right? I think, you know, VCs really look at things on a 1 to 2 year basis. We will compute in our heads whether the company will be on a path to exit in 6 to 10 years, but we're really not thinking about it right now. I mean, particularly the early stage VCs, the way we derive whether this is an exitable company is by asking the classical questions. Is this company solving a problem in a way that is 10 times better than anybody else out there? And secondly, is the problem a big problem, right? If you have those two ingredients, the third ingredient is the most important, of course. Is this the right team to do it? But if you are able to answer these 2 to 3 questions, then we know that we're on a path towards a typical exit. But actually doing the projections of the exit when you're at pre-seed or seed, and unless you think that you're not going to get to a big success, and you think, okay, I'm going to do a seed round and then I'm going to exit, but that's not interesting for VCs, because nobody does. You know, VCs don't invest in companies that are going to be sold for 10 to 20 million. They might have to sell them for 10 to 20 million if things go wrong, but that's not the idea. So that scenario shouldn't be there in your slide deck. So the exit should be, when you talk to VCs that are series A, B, C plus, they think about exit because they're already closer to the exit. So they're like, okay, there might be only 1 or 2 more rounds after me. So I need to think about exits. When you speak to a pre-seed to seed VC, you're talking about 5 to 6 rounds away from the exit. So it's really not on our radar. It is, but indirectly.
Yeah, and I really like your point of saying that you don't need to show the path to the exit, but you need to show that you can be an exit. So you need to show that
One
the
day.
potential is there, and then of course you need to also be able to show that you understand what you are and what you aren't, and then you want to know as a founder yourself, am I fit for VC or am I fit for angels who then take me to a 10 or 20 million exit? So in that sense, I really like the way you put it here, Stephan. Now we had a question. So we had one question from David Rufino, yes, which I think you just replied to, which is, should you put a date, yes, right at the beginning? And you just said very clearly, definitely no. Don't go ahead and try and do that. So let's go to Bernard's question. And Bernard, all of you, feel free, if you put live in brackets, then you can ask the question directly to Stephan and join in the conversation. Feel free to unmute Bernard and then add to it, but now I'll read it aloud and then join in the conversation with Stephan as well. And Bernard, you asked, typically many VCs support follow-on rounds, and how easy is it then for a VC to exit generally? Can you say that there is an average exit term? And you've also...
Yes. So as you know, VC funds last for about 10 years. So you want to get in, you as a VC, you want to get in and you want to get out within 10 years because you're supposed to give back all the money to your investors in that time frame. And the sooner the better, because IRR, internal rate of return, depends obviously on time. So the higher the multiples, the better, and the sooner the better, so that your IRR, compounded IRR, is higher. And that will allow you to fundraise more. But we never know when you can exit. So there's 2 ways of exiting. One is through the typical route where you get in and then you decide at some stage that everybody's going to come out and exit at the same time. It happens nevertheless quite often, particularly when the market is hot, that early stage investors, particularly angels and pre-seed funds, are able to start exiting a little bit sooner and ahead of the real exit, let's put it this way, of the final exit. That obviously has its pluses. And so sometimes, and we've done that in the past as well, sometimes you think, okay, I'll exit, I will sell a part of my shares, a piece of the pie before the final exit, because for some reason I think that I should diminish the exposure, I should give money back to my investors for some reason, because I'm fundraising for another fund or something. Or I think that the company kind of has peaked and I'm not sure if there's going to be an exit, a better exit point in the future. So the mix of those kind of thoughts are inside the head of the VC, particularly the early stage VCs and angels. On the other side of the coin, what happens is if you exit too soon, you're just leaving a lot of money on the table, right? Because you're exiting at $1 billion valuation, and then suddenly the company's worth 10, and you're like, oh my God, I could have multiplied my money by 8 to 10 times or something. So it's a tricky decision, but there's ways of exiting, and particularly when companies are successful, and this happens to us quite a lot. We get lots of emails and contacts from investors saying, I know that you are investors in companies such and such. We are buyers of on the secondary market. Would you be willing to sell? And mostly we're not, but everybody has a price. So sometimes we say, well, at 50 times what we've paid for, we'll exit, right? And sometimes that's not possible. Sometimes it's possible.
Can you just put some words into that, because I'm not sure if everyone is fully aware of that nomenclature, secondaries, what that is, just so everyone's on the same page.
So the primary market is when you buy shares in a company in the transaction, let's put it this way, in a simplified way. when you buy shares of a company, you're buying it from an investor that bought them in the primary transaction, so in an investment round. So we do a Series A, that's a primary transaction of shares. There was a capital increase. And then a few years later, there is no round, but the company is doing very well, and another fund says, I would like to buy your shares or part of your shares. And we sell them those shares, hopefully at a very nice multiple, and that's a secondary transaction. So they were not part of the original transaction. They're having those rights because they bought them from us.
Stephan, one of the most typical things that I hear from founders new to the VC space is that they fear that if they take on VC money, they will also be taking on someone who will pressure them towards an exit, and they might have to sell before they would want to themselves. Could you maybe nuance that perspective a bit and say how you what you do and what you don't do terms wise? Because everything comes down to governance.
Yes, so that is always partially true. So the flip side of taking venture capital money is that people want to exit, right? We have 10 years to get in and out. So, and quite often in the sort of like agreement, shareholders agreement, there will be a clause that says that, whenever we want to exit after a few years or say, something like that, if there's no further follow-on rounds, if this clause has not been, let's say, obliterated by another new shareholders agreement, we will have the right to actually force the sale of the entire company, because VCs have a minority stake. So nobody's going to buy particularly if things are not going to go extremely well, if there's no secondary offers, we need to exit. And so we will need to be able to force the sale of the whole company. But if you believe in your own company, that should not be a problem, because most likely things will go well. There will be follow-on rounds, and nobody's going to execute that put, and that put will cease to exist when there's new rounds and new money, and those clauses disappear, or they become, enforceable by other later stage VCs, where they say, if we don't achieve an IPO in 3 years, then I have the right to put up the whole company for sale. Now, so this should not be a problem, and it's quite standard that you have those clauses, which is like, if things don't go well and I need to exit, I will take you with me. It's a drag along clause. It's quite standard.
Would you try and be as specific as you think you can within standards there, and say, what is the standard that you should see or be okay with seeing in the pre-seed seed space?
Yes, if you should see a drag along at pre-seed, VCs will say, if nothing has happened in 5 to 6 years, we have the right to actually drag you along and sell the whole thing. This is a very unlikely scenario, because if nothing has happened in 5 to 6 years, most likely you have run out of money. So this is not a problem. Or the other scenario is, okay, I mean, the company is kind of on break even, they pay for themselves, but it's really going nowhere. It's kind of a zombie company that is just there paying for their salaries, and then we need to get rid of it. We need to sell it, all of us. And because we're not going to sell only our, say, 15 to 20%, because nobody will buy 15 to 20% of a company that is not growing, but maybe someone will buy 100% of a company that is not growing by adding it to someone else. So people will want control. That's why those clauses exist. And something similar for the IPO scenario, where you're kind of a later stage fund, not our case, but they might say, look, we are coming in at this super high valuation. Let's put it this way, we're valuing at, a pre-IPO level, but we need to exit or do an IPO in the next 2 years or 3 years, because we compensate the very high valuation with a very good IRR, because it will not be a huge multiple, but it will be a very fast sale. And so later stage funds will have their own pressures, and but these are standard terms. And now the good thing of the whole story is that if things go well, and if the new owners, because there's always new owners, whenever you sell the company, there's someone else that is the owner, right? And so if you're bought by a corporate, most likely the corporate will want you to stay at least for a couple of years to do the transition. Eventually, if you like the corporate and they like you, you might become a very senior executive at that corporate, or even at the board, depending on what kind of transaction and the relative size of those companies. So that's one scenario. The other scenario is an IPO. On the IPO side, quite often the founder remains as CEO or chairman and CEO. So, for example, for Farfetch, which is one of our unicorns that is no longer with us, of course, in our portfolio, but was the first Portuguese unicorn, and we were the only Portuguese fund to have invested through a secondary, by the way. José Neves is still there. He's still the CEO of the company. 15 years on, he's still there. The company is publicly traded on the New York Stock Exchange, and everybody else has exited or mostly exited the funds, but he's still there. He's still an owner, a part owner of the company. And there's many other instances where actually you do not have to leave your company if things go well. In fact, if things go very well, what we've seen is that founders become even more powerful in the company, sometimes a little bit too powerful. I mean, with dual class of shares where they, I don't know, control 15% of the stock, but own all the voting rights and stuff like that, which is actually illegal in some countries, not in the US, because it's not very democratic, right? That you have economic rights and voting rights which are unconnected or disconnected. But so there's lots of nuances here.
We have here a question by Mizan. He's asking if there are any particular requirements for organizations to fundraise, or any organization can apply to fundraising. I'm maybe going to reframe this a bit, Stephan, and ask you to first, maybe from a more macro perspective, what are venture-like businesses? So yeah. What are the businesses that VCs are looking for? And then maybe bring it home by maybe restating what you already said, but making it more detailed. What is Indico looking for?
Yes. So to the general question of, is there a requirement for an organization to fundraise? Yes. I mean, organizations or companies need to be interesting, right? They need to be interesting for whatever type of capital that they're looking for. But not all investors look for all types of companies. If you are a regular business, which is the majority of businesses in the world, of 99% of the businesses in the world fit into this category, which are, a regular bricks and mortar product or services business, you are not a VC, a venture capital type of company. And I'll tell you what a venture capital type of company is required to do to convince a VC. Because for a regular business, if you're a private equity investor or some sort of other individual that want to invest in a business, the questions you're going to ask is, do you have clients? Do you have profits? How good are your margins? Is this a nice, good business that has some capacity to grow? That's the basic question that everybody will ask for a regular business, whether it's a restaurant or a coffee shop or a library or whatever it is. If you're looking to pitch to a venture capital investor like ourselves, we go back to the three main questions, because we're looking for super high growth businesses that we can exit within 10 years. The reason why we look for super high growth, and then I'll explain why super high growth is normally tech, is because we have 10 years to get in and out into businesses that are super risky. Every new business is super risky. Even if it's not high tech, even if you just do a shoe shop, it's super risky. You don't have clients at the beginning. You don't have a track record in selling shoes. You don't have capacity and people and so on and so on. So these are always risky businesses. And the only businesses that are able to overcome that risk with super high returns are businesses that grow very fast and therefore can become very big and very successful to compensate for all the other ones that have failed. That's why VCs only invest in technology, mostly, with very few exceptions. Businesses that are very, hopefully not too capital intensive, don't have too many physical assets, because producing say a chair is way more difficult than producing software. You just go there, you change the software, it's done, and then you just copy it, send it over the internet. It's everywhere. If you do the chair and the chair is not properly built, you sit on it, it breaks, that's it, there's no more chair. So physical assets are something to avoid. for VCs because they're complicated. You know, the real world is way more complicated than the metaverse. And so basically, you know, we prefer the metaverse where things are copyable and easily scalable. And so the questions we ask is, what is the problem that you're solving? Are you solving this problem in a way that is 10 times better than anything out there in the whole wide world? Is this a big problem, which means, are there a lot of people that are going to pay for this solution that you're bringing to the market, be they companies or people? And lastly, you know, are you the right people? You know, do they have the stamina, the ambition, the drive, the grit, the willingness to put up with the VCs and with many other advisors? Can you attract the talent? Are you a leader? Will people follow you? Will you get along well with us and with the rest of the employees? We do a lot of psychological analysis to our founders, particularly when we start putting in some serious money, which is super helpful for them because they get to know each other better. They get to know their teams. We get to know them better and understand, you know, what are their motivations. And so, you know, it's a psychology game, essentially. It's a motivation game.
I'm asking a question that's a bit out of the exit realm, but I know that we have some people here in the group listening in who are pondering doing a crowdsourcing campaign as their first round, and you know, everything that you do from the day you start as a startup in a way affects your exit process and where you're going to end up. So it might, doing something stupid for their first round might affect what you can do in your seed round, which then ends up blocking your way to the exit that you're dreaming about. So I'm curious to hear your take in general on crowdsourcing and what are the pros and cons.
Right. So yes, to your point, Andreas, this is like building a CV, right? You're building your company, you're building your CV. If you go in and work out of, look, it starts, if you don't go to a really good university, you're going to have a harder time getting a good job in general, right? If you go from that university into a tiny company that nobody has heard of and is not very well known for having great people or not well known at all, that's worse than working for the Boston Consulting Group or Goldman Sachs, right? So you're building up your CV, and in the companies, it's the same. If you take the wrong kind of capital, that capital is not going to be smart enough to advise you on what are the strategic steps you need to take in order to raise more capital to keep on growing, to become a global category winner. It's not by chance that the returns of venture capital funds are always concentrated in the same funds. So it's an asset class where, contrary to, say, I don't know, mutual funds that invest in bonds or even private equity, where the returns of all the players are kind of similar. Of course, in private equity, there's a little bit more breadth and there's some that do very well and others that don't do very well. But in VC, the funds do either very well or not very well at all. And you want to be with the guys at the top here, right? Again, it's another example I like to use. If you want to be a football player, you start by going and joining the school of Manchester United. If you're from Manchester, you're not going to join the school of, a third grade club in Manchester. If you're good enough, you go to Manchester United when you're 5 or 10 years old, right? And that's what will put you on the right path. And that's what is called smart capital. It's not by chance. These people, the best funds are successful because they ended up attracting the best founders because they're smarter, they help more, and then they end up placing the founders on a path of more success, more fundraising, and then they do the right exits, and it's like a snowball. Then they attract, again, the best founders, and it's a self-fulfilling prophecy. When I was at Harvard, they would say, educating the leaders of the future or something. And of course, you're chosen immediately because you have the best grades, you have a great CV and so on. The self-selection is already there, right? So of course they will then just pump you a little bit more. And it's the same thing in VCs and jobs and everything. You want to be on the right path. You want to have smart capital. So crowdsourcing, crowdsourcing, to your point, Andreas, crowdsourcing sometimes is useful, particularly if you have a B2C product that you need to have exposure in the market. But crowdsourcing is not smart capital, because it's just the crowd, right? And the crowd is not going to be side by side with you, telling you, how you're going to get in touch with Andreessen Horowitz, because they don't know Andreessen Horowitz, right? And they don't know what is talent. It's just a tiny bet that several individuals, maybe very smart individuals, took, but they're not side by side. So crowdsourcing is not a great alternative, unfortunately, unless you're launching, a physical product, a t-shirt company or whatever, something like that. That's great.
We have some questions in, so let's look at them. We have Aurora Batista asking, how do you value intellectual property versus open source?
Well, so that depends. There are companies where intellectual property is super important, say, for example, in biotech companies. But even in those, sometimes you really don't want to have the patents out there, because otherwise you might get copied and so on. And so the alternative to that is actually trade secrets. It's not open source. Trade secrets are super important. And so VCs tend to understand what are the trade secrets in terms of product, in terms of business model, in terms of channels, distribution capacity, growth hacking. How do these people intend to grow their company? On the other hand, and about open source, what I would say is, when people tell us, look, for you to take a look at our business plan or pitch deck, you have to basically sign an NDA. We're like, look, I see dozens and dozens of business plans every week. I don't have the time to hire lawyers to take a look at NDAs, right? And we're not in the business of copying entrepreneurs. So that's one side of the question. When you go into real open source, with the advantage of open source is that nowadays you can build on top of open source to build a great product where you will have trade secrets. But open source is good as long as you can use it, or someone can use your open source, and you can put a business model on top of that somehow. So IP important, but not as important in tech. Yes, in biotech more important, of course, and in everything that is hardware. And open source is absolutely the basis of everything that is done. It's like Lego. People nowadays build businesses like Lego. So you have an open source base, and then you have little open source Legos that you put on top, and then the cherry on top of the Lego is your trade secret and the way you're going to put the whole thing together. Quite often that happens.
Stephan, would you like to ask your question live by unmuting yourself? Yeah. We can't hear you. Well, I'm gonna go ahead and read it, and feel free to join our follow-up. Stephan wrote, is there a rule of thumb on the exit strategy, and what do you write in your term sheets? And I guess, yeah, go ahead.
I'm not sure exactly what that means, right? We've talked about exit strategy, where basically you end up either going for a trade sale, which means you try to auction your company to several bidders that might want to pay for it. Hopefully, people will want to buy your company and not you wanting to sell it. Or you go the IPO route, and there is no rule of thumb. It depends on a case-by-case basis, and whether you're a very early stage, mid-stage, or later stage company, and whether the funds need to sell, whether they'll drag you along or not, as I've covered before. I think that's normally not part of the term sheet, except those kind of last resort rules where if nothing happens, we'll drag you along and we'll all sell, something like that within a few years.
And we have another question from Rashid Ali asking, what is your method of startup valuation at the seed stage? And I would like to add to this also, tie it to the exit point, right? Because I think that's, even though it's not how you evaluate, I have yet to meet a VC in the seed stage looking at the exit value and then deducting the the price from there. But I think that it's worth saying, what are you looking for at the seed stage when you are evaluating a company when considering the exit?
So seed stage valuations are more artistic than sort of scientific. So I'd say it's more of like a psychological game. You want to make sure the first question we ask is how much money do you need for the next year and a half, which is the time frame that you're able to sort of control. And let's say people will justify that they need 1 million euros, to build up the team, to continue to build up the features of the product, to develop client relationships, to do customer acquisition with Google AdWords. Let's say it's something like that. And if we believe in that, and if we like the company, we say, okay, so you want to raise 1 million euros. Let's say we'll do the round alone, or the set of investors that is coming in. We'll probably look for a dilution of around 20%, 15 to 25, sometimes 10, but on average 15 to 20%. So the company will be valued at 5 million. And a lot of people, particularly outside of the ecosystem, will say, you're crazy. Why would you value a company that loses, tons of money every month? Why would you value it at 5 million? Well, it's actually not valued at 5 million. This is just a byproduct of, 1 million is worth 20%. So the question is, why 20% or 15 or 25? Well, there's some rules of thumb. You want to dilute the entrepreneurs at a certain rate where they're still interested, where they're still motivated, because there will be several funding rounds. And if we would dilute the entrepreneur by 80%, then he would stay with 20% of the company, and he's still going to get 10 million, and then another 50 million round, and then another 150 million round, and then suddenly he'll have 0.3% of his own company. So he's basically an employee of the company, and he might as well go somewhere else and have another job that maybe pays him better and with less pressure. So you want to keep people motivated. It's kind of a carrot and stick approach, and that's how you use to do value. That's why you do valuations. Of course, you can look at multiples of sales or monthly recurring revenue, but that's typically the way you look at valuations more on the later stage rounds, where you're closer to exit, and so your financials are a little bit more stable, hopefully, and your margins. When you're at seed stage, it's too early to actually have you should have proper financials, you should have proper accounting, hopefully even auditors at some stage, but it's not a stable balance sheet or P&L, so there's no point on doing a lot of financial wizardry. And by the way, when I see a pitch stage deck full of net present values and lots of discount rates and so on, I'm like, oh my God, these guys have no idea. I have no idea why did they bother do this, right? Garbage in, garbage out. Don't come up with business, with models and I calculated this net present value and therefore my company is worth 10 million. It could be worth billions or zero. It depends on the numbers you put in on the Excel spreadsheet, and you have no track record, so nobody knows. There's no point on doing that.
We have.
I think one question that's very close to tied to this is from Lloyd. So I think we should just bring it up now. He's asking, do you base your estimated exit valuation on comparable companies? And if yes, how do you choose comparable companies?
Yes, well, sometimes it's not easy to look at comparable companies because sometimes things are so new and so different that it's not easy. But there are rules of thumb. Again, if you're talking about a SaaS company, if you're talking about the marketplace, if you're talking about e-commerce, you can, and particularly if you have quoted companies or public companies that are trading and that have similar business models, you can go and check, for example, what is the multiple of sales that a similar company is trading on the stock market, or a group of companies, hopefully, that are similar. And you can say, well, this company, which is pre-IPO, maybe a couple of years away from IPO, they might become public. It might become public. It might be worth, 2, 3 times, 10 times sales. I don't know, depending on how crazy the market is. And therefore, this pre-IPO company could be valued currently at a similar multiple. That's the way you do it.
I think that just yesterday or a couple of days ago, we spoke to one of the guys at Frontline who are very much investing in the UK and London ecosystem, and they're in B2B SaaS, so that's the most competitive place you can be in, and for that reason they're looking at valuations that are much higher than 5 million euros in the very pre-seed rounds, and and they're ready to do investments at just 10% of equity for the full
Yeah.
round. And that's
Yeah.
just, that is of course them looking at comparable companies, and then it's often pedigree founders that have done a bunch of
Yes.
startups before. So yes, 100% you can look at comparable companies, but it's also about comparable founders and it's
Yes.
about the competition that you're in and everything. So
Yes.
it's not
I
as
would comment that. I would also add a comment, which is the negotiation needs to be always good for both sides. We should never stretch it too much.
Yeah.
When the market is too good for VCs, the VCs should not take advantage and say, well, by the way, I'll take 30% instead of 20 or 40 because you have no alternative, right? That's not good because it will demotivate people. But the opposite is also true. Just the fact that you're able to only give away 10 or 5% doesn't mean that you should do it. Number one, your VCs are going to be less motivated. If they have 20% on the other company on the portfolio, they'll help the other company more because they'll have, I might get, better return from this one that I have 20% or 15. If I only got 3% from these ones, I don't care, let them go, right? And so that's not very motivating either. So that's not good. And then on top of that, you're setting yourself up for failure because that means that you're raising at a very high valuation. Say, you really have the metrics to be valued at seed stage at 5, but you're in a super competitive space and you get valued at 10. And so then you're going to have to grow into your valuation on the next round, which means you're super far of your valuation on a metrics basis because you should have your MRR of 50K per month and you have a 3K per month, but you're so hot and so good and you got away with it. So you're valued at 10 million. And then on the next round, people are going to say, so what have you built? Oh, I moved from 3 to 15. Yes, but that's still very far from Series A. So it's a double-edged sword. And I think so, greed is not good. Greed is not good. And then on the other hand, from the VC point of view, and we wish them luck with all those VCs that do those kind of deals which are not ideal, because the returns of the fund will suffer, and it'll be harder for them to raise another fund, which means that there will be less, capital available for startups in the future. So you shouldn't go from boom to bust because of excessive valuations or too high or too low. People should be reasonable and should have a good deal for both sides, something reasonable, right? If you have the power to force something else, don't necessarily exert the power to do something else because it might come back to haunt you.
We have Usman who's requested to ask a live question. Go ahead, Usman.
Hi, Stephan. Are you able to hear me?
Yep.
Yes.
Gotcha. I'm in New York City. This has been awesome. I just wanted to ask, so your background was that you were educated in the US and you spent a few years here and then you moved back to Portugal, and obviously you've reached a great level of success over there. I sort of wanted to ask, how were you able to navigate that journey of bringing what you learned here back home? Because that's something I'm interested in doing in the future when I'm a little bit more established for my country, Pakistan. So just any advice on that?
Yes, number one, sometimes things happen by chance, right? When I had been away from Portugal quite a few years, and when I graduated from the US, I ended up having an invitation to come back to my country. I had never worked in Portugal, and then I came back, then I went out again, and then I came back, and then I went out again, and so on. So it's been on and off, and now I've been here for quite a while, and I love it, and I intend to stay. Everybody likes to be in their own country, obviously, right? Except if there's famine, war, or dictatorship, I guess. Otherwise, you prefer to be in your country rather than be somewhere else because you like food, you like people, you have your family, stuff like that. I think when you come back to your country, and if there's less people like you, in a sense that you are more unique, there's a lot that you can add to society. Not only you can do well personally because you have certain skills or certain knowledge set that others don't have, but you can also contribute much more. And you can also get more recognition in a sense that your weight on society is bigger. So that also gives you satisfaction that you are giving back to a certain extent to the growth of your company, of your country. Of course, you need to come in at the right level, at the right width. So expectations cannot be too high or too low. It depends. And I think that for me, the most important thing, it has always been to work with the right people. both when I was junior and now when I hire people to work with me. Work with the right people that have the same set of values, that have the same levels of ambition, but in a good way. That you're going to have fun working with, that you're going to learn with, whether they're above you or below you. So people that you like, because you're going to be doing this for a long time. And so going back to your country is great, but you need to get in at the right moment with the right opportunity.
That is a great way to end. Thank you, Stephan, for that kind of professional tips as well. It's super nice to hear. Well, before rounding this off, I'd just like to thank everyone for being here, particularly Stephan for his time and availability and knowledge. And I would invite you all also, if you'd like to attend more of these sessions, you can always subscribe to our Slack channel. It's, you know, a community of founders, but also emerging managers. So feel free to join it. To do that, you just need to go to theeuropeanvc.com, and it's a free community. So no harm, no foul. Andreas, do you want to share with us who's going to be our next guest?
Yeah, for sure. First of all, thanks, Stephan. It was awesome. I'm super happy that you took the time here to talk to us, and I'm also hoping that everyone here understood how much, even though exiting can seem like a discipline of the VCs, there's a lot for founders to think about throughout their journey, and there's also a lot of how should we put it, misconceptions around what you need to be able to deliver at the pre-seed and seed stage, and how much is worth saying. Stephan, would you like to say anything before I say what's up next?
No, just thank you so much for having me, and hope everybody is happy, successful, have happy holidays if you're going to have some. And so just pleasure to be here as usual.
Yeah. Thanks a million, Stephan. Next time is next year, because this is the last one of the year. It's on January the 19th, and we're going to be talking to Victor Gallström from a new VC firm called VEC in Stockholm. And we're going to be talking about picking and evaluating venture studios and accelerators, and how to really figure out exactly whether you should say yes to that offer of 3 months of intensive care while you then pass along 8% ownership stake. Sometimes that's not the best deal that you can get. So that's going to be super interesting. And everyone join our community, as David said. I think that everyone here as founders would get a lot out of the insights that we're teasing out of VCs in there, and have collected in a very structured process for you to get ready to fundraise. Bye.
Thank you, Stephan. Bye, everyone.